mind, looking for a dime. James Locke in the house, gonna help you shine.
Hello everyone and welcome. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer more Ask James questions of the day. First question today is from Alan. And he says, early on in my career, I invested in mutual funds instead of individual stocks, and it worked out well for me. So why won't this work in retirement? All right, Alan. First of all, mutual funds are a great example of simplicity. And as a great friend of the show and another great person with us in our team often says the term that he coined, the disease of ease. And yes, mutual funds probably did well because if you're approaching retirement, you're likely around, mid 50s, late 50s, which means you experienced the 80s and the 90s when mutual funds performed exceptionally well. Even though, you had a hiccup for 13 years in the early 2000s, well, you were still contributing at that point. You were buying more shares and dollar cost averaging, so even though it didn't feel good, you didn't need that money immediately. It was a long way away before you needed it, and you were still accumulating assets at a cheaper point. This meant that when the market eventually rebounded, your investments sprung back twice as fast. Now, for the last decade or so, we've been, back in the good times. So I completely understand why this approach has worked for you and why you're happy with it. But what I want you to understand is that when you retire, you enter a different stage of life. Suddenly, the same strategies that were beneficial before can become detrimental. The fact that market dips were advantageous when you were a net contributor to the market because you were dollar cost averaging and buying more shares every time the market was down, it changes in retirement. The equation reverses itself. You become a net distributor of assets when you're net distributing money and the market drops. You have to sell more shares when prices are down to maintain your retirement income. This is essentially reverse dollar cost averaging. And if the one approach is good, then the other can be quite harmful. Unfortunately, most mutual funds are not designed to generate a significant amount of income, which becomes crucial in retirement. In a typical mutual fund portfolio, if you're lucky, you might get a 2% interest or dividend stream net of fees. That means on a $1 million account, you're only getting about 20 grand a year. This is where the simplicity that has helped you in your entire life can potentially become a hindrance in retirement. Moreover, it's important to consider that in retirement, you need a strategy that not only preserves capital, but also provides a steady, reliable income stream. Now, this often requires a shift from growth-oriented mutual funds to more income-focused investments. These might include dividend-paying stocks, bonds, real estate investment trusts, REITs, that's what they're called, real estate investment trusts, or even annuities, depending on your specific needs and risk tolerance. Remember, retirement isn't about just growing your nest egg anymore. It's about creating a sustainable income that can support your lifestyle for potentially decades. Now, this often requires a more hands-on approach and a diversified strategy that balances growth, income, and capital preservation. So while mutual funds serve you well in your accumulation years, it might be time to reconsider your approach as you enter this new phase of financial life. Great question today. Thanks for the awesome question. If you'd like to send in your question, you can do so by emailing it to poollocke@poollocke.com. Moving right along, we're getting on to our second question today. It's from Rebecca. She says, I have a sizable IRA and I've used ETFs really for simplicity's sake. But what's your opinion on that strategy? All right, Rebecca, ETFs, they're a little better than mutual funds, but they're really not the best option, especially when investing for income in retirement. Now, it's interesting because, I've never been a big fan of ETFs. Now, for all the viewers out there who may not be familiar with ETFs, the term stands for exchange traded funds. So it's like a mutual fund in many ways, but it's traded like a stock, which means you don't have to wait until the end of the day for it to trade. You can trade at any time during the day like a stock. You can put stop losses on it. You can put limit orders on it saying, hey, you want to buy it only if it's below this price, or sell it if it's above that price. None of which you can do with mutual funds. So are ETFs generally considered a little better than mutual funds? Yes. And the fees typically tend to be a little bit lower in some cases, but the limitation is that they're still pooled vehicles, they're still funds. And you see, I've always been a fan of holding individual securities rather than funds. Now, interesting, my company, Sound Income Strategies, actually started 2 of our own exchange traded funds. So why did we do that? If I'm not a big fan, well, we did it because smaller investors who don't have enough money to cost effectively diversify sometimes do better through some type of fund. And if I'm picking the lesser of 2 evils, I would pick the ETF over the mutual fund. But Rebecca, if you have $250,000 or more, then you can cost effectively diversify with individual securities, which means you don't need to go the ETF route. You can go a lot further with individual securities and get similar diversification and probably put yourself in a better strategy for generating income in retirement. When it comes to investing for income, which is crucial in retirement, individual securities offer several advantages over ETFs. For one, you have more control over your income stream. With individual dividend-paying stocks, for example, you can select companies with a history of consistent and growing dividends. This can provide a more reliable and potentially growing income stream compared to an ETF, which may include companies that don't pay dividends or have inconsistent dividend policies. Additionally, with individual bonds, you have more control over your fixed income strategy. You can create a bond ladder with specific maturity dates that align with your income needs, something that's not possible with a bond ETF. This can help manage interest rate risk and provide a more predictable income stream. Another advantage of individual securities for income investing is the ability to manage your tax situation more effectively. With ETFs, you're subject to capital gains distributions that you can't control. But with individual securities, you have more control over when you realize capital gains, which can be particularly beneficial in retirement when managing your tax bracket is important. All right, great questions today. If you'd like to have your question answered like I did today, you can email them into poolelock@poolelock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See you guys next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.